So for this question, we should choose option A. Okay, here the inflation rate in New Zealand increased while US inflation stayed the same. Okay, so the price of products in New Zealand would be higher compared to before. So there would be more people now buying US goods. There would be more people exchange New Zealand dollar for US goods and less people exchanging US dollar for New Zealand dollar to purchase New Zealand goods. Okay, so there will be a lower demand for New Zealand dollars, right? So that's why there's an inward shift in the demand schedule for New Zealand dollars. Okay, so the lines shift inward. It will be moved to the left. For each price level, there is a lower quantity of demand for New Zealand dollar. And there is a outward shift in the supply schedule for New Zealand dollar. Okay, so there will be more people supplying New Zealand dollar, exchanging New Zealand dollar for US dollar. If a country experiences high inflation relative to the US, its exports to the US should, imports should, and there is what kind of pressure on its currency's equilibrium value. Okay, think about it, let me know. The right option should be D. Okay, when the high inflation rate is higher in the foreign country, there is a lower demand for its products or its currency, right? So the exports to United States should be lower or decrease, okay, because of the higher price. And its imports should increase because then US products will be relatively of lower price, right? And there should be a higher demand for US currency as well. There will be a downward pressure on its currency's equilibrium value because the demand for the foreign currency is lower and the supply of the foreign currency should be higher than the equilibrium price of the foreign currency should be lower. Okay. So I mark here, there should be higher. When I say domestic price here, it means the price in the foreign country. Okay, it should be higher because of the higher inflation there. So there's lower demand and higher supply of the foreign currency. Okay, and lower exchange rate for the foreign currency. I just made a little change to the slides and deleted the word domestic in case you would think I'm talking about US, United States, but anything here is talking about the other country, okay? If you're residing in the other country, it would be your domestic country and domestic currency. If you're residing in US, it will be the foreign currency or the foreign price, okay? But anyway, any of the hot price or currency here we discuss about is for the other country outside of US. Next question. An increase in US inflation relative to Singapore inflation places upward pressure on the Singapore dollar. Is this true? This is true. Okay, when the inflation rate in US is higher, the price in US should be higher. Okay, there will be more people purchasing Singapore US Singapore goods. Okay, demand for Singapore currency would be higher. Okay, demand for Singapore dollar would be higher, so the price of Singapore dollar should be higher. Okay, there will be an upward pressure on the Singapore dollar. The second factor is the change in exchange rates. Interest rates. Okay, so we just discussed the first factor that influences exchange rates, which is the inflation rate. Now we come to the second factor here, relative interest rates between the two countries. An increase in US interest rates could lead to an increase in demand for US deposits and a decrease in demand for foreign deposits. Okay, so here we're saying that when there is an increase in US interest rates, more people want to deposit in US dollars instead of the foreign currency. So there is a higher demand for US dollars and lower demand for foreign currency. And this will lead to also, again, increase in demand for dollars, a decrease in supply of dollars. Okay, because fewer people are exchanging dollars for foreign currency, so there is a decreasing demand for a decrease in supply of U.S. dollars. So the exchange rate of U.S. dollar would be higher, right? Because the demand is higher and supply is lower now. This situation also leads to a decrease in demand of the foreign currency and an increase in supply of foreign currency. So the exchange rate for foreign currency decreases. If we look at this graph here, okay, we're talking about after the US interest rate increases, okay, more people want to exchange foreign currency for US dollar to deposit in United States. So the demand for the foreign currency decreases. So you can see this blue line is shifted inward, okay? It's moved to the left-hand side or moved down parallelly because for each price level, there is a lower demand for the foreign currency or British pound. And then on the supply side, there is a higher supply of the foreign currency, so the line is moved outward or moved to the right, or for each price, we have a higher quantity demanded or supplied, okay? So we have S2 here. So our equilibrium price for this foreign currency is now lower, okay? Because the demand is lower, supply is higher for the foreign currency when US interest rates increase. Question: an increase in US interest rate relative to Japan interest rates would likely to how do it affect the US demand for Japanese yen and how that affects the supply of Japanese yen for sale. Okay, think about it. Pause the video. The right option should be A, okay? The demand for Japanese yen should be reduced and the supply for Japanese yen for sale should increase because more people are exchanging Japanese yen for US dollar to deposit in US. Okay, on the other hand, the demand for US dollar should increase and the supply of US dollar should decrease. As a result, the exchange rate or the value of US dollar should increase and the value of Japanese yen should decrease. Another question, if the Fed announces that it will decrease US interest rates and the European Central Bank takes no action, then the value of the euro will against the value of US dollar, holding other factors constant. Which one should we choose here? Right, appreciate, okay? If US interest rates are depreciating, then relatively the interest rates of, even though the European interest rate doesn't change, but relatively the interest rate is relatively higher than the US interest rate now because US interest rate decreased. So more people are exchanging US dollars for euro, so the euro value will increase and the US dollar value will decrease. If a country experiences an increase in interest rate relative to US interest rates, the inflow of US funds to purchase its securities should, the outflow of its funds to purchase US securities should, and there is pressure on its currency's equilibrium value. Which one should we do? The right answer should be, if you're ready, let's look together. C, okay? When the interest rates of the foreign country increases, more people will be willing to exchange US dollar for foreign currency to deposit in the foreign country instead. So the inflow of US funds to purchase securities should increase. The outflow of its fund to purchase US securities should decrease. Okay, more people want to purchase the security of that country, specific country, foreign country, instead of purchasing US securities. And there is upward pressure on its currency's equilibrium value, right? Because the demand for the foreign currency increases and the supply decreases. So the value of the foreign currency should go up. Okay, so that's the first two factors, including relative interest rate and relative inflation rate between the two countries that could affect the exchange rates. And we've discussed different scenarios. Now we want to introduce the concept of Fisher effect. Okay, you probably learned about it already in your business finance principle class, right? 312. The real interest rate equals nominal interest rate minus inflation rate. Remember when we say when we were calculating the nominal interest rate for bonds, remember we have R star, the real interest rate, plus inflation rate IP, and plus other risk premiums, including maturity risk premium, liquidity risk premium, what else? Default risk premium, right? So for our nominal interest rate, or for our bond interest rate, or any risky or even riskless assets, the nominal rate equals real rate plus inflation, right? That's Fisher effect. Okay, so we want to address this effect here again. And this question is testing us the knowledge about Fisher effect. The real interest rate adjusts the nominal interest rate for C, okay, inflation. So we can tell the two factors, the first two factors that affect exchange rates, including inflation rate and interest rates, they're actually related to each other, okay? Assume that the inflation rate becomes much higher in Mexico relative to the US. This will place what pressure on the value of Mexican peso. Also, assume that Mexico interest rates begin to rise relative to US interest rates. The changing interest rates will place what kind of pressure on the value of Mexican peso? Pause the video, think about it. Okay, so if you're ready, yes, the right option is C. Okay, so we have two sentences here testing us the two different factors. For inflation rate, if it increases in Mexico compared to US, we know that Mexican prices are higher now, so more people want to purchase in US instead. Okay, more people want to exchange Mexican peso for US dollar, and fewer people would exchange US dollar for Mexican peso. So the demand for Mexican peso will go down, supply will go up. So this will make the value of Mexican peso go down. Okay, so there is a downward pressure. On the other hand, Mexican interest rate, if Mexican interest rates increase, okay, relative to US interest rates, then more people want to deposit in Mexican Mexico instead of US, right? So the demand for Mexican peso will go up, supply will go down. In this case, there will be an upward pressure on the value of peso. Okay, that's the first two factors. Here we want to introduce the third factor, relative income level of the two countries. For example, if there is an increase in US income, it will lead to increase in US demand for foreign goods, increased demand for foreign currency relative to US dollar, and an increase in the exchange rate for the foreign currency. Okay, so when there is an increase in US income, people are wealthier now in US, so they would demand more of the foreign goods, foreign currency, and the value of the foreign currency will go up as well. However, the supply of the foreign currency does not change. Okay, if we assume that the foreign income level does not change. So the demand for US goods or US dollar does not change. Okay, so interestingly, increase in US income only affects the value of foreign goods, which and or the demand for foreign goods or foreign currency, and the exchange rate for foreign currency goes up. Okay, so this is different from the first two factors. It only affects the supply and demand for the foreign currency, thus the value of the foreign currency. So here we can see that, excuse me, so it only affects the demand for the foreign currency. It does not affect the supply of the foreign currency, okay, just one direction. So here, the demand for foreign currency increases. The demand curve is moved outward, while the supply of foreign currency does not change. So the equilibrium price goes up, the value of the foreign currency goes up. Question: a large increase in the income level in Japan, along with no growth in the US income level, is normally expected to cause, assuming no change in interest rates or other factors, and in Japanese demand for US goods, and the Japanese yen should. Okay, pause the video, think about it, let me know. The right answer should be B, okay? If the income level in Japan increases, then there is a higher demand for US goods, higher demand for US currency, the value of US dollar will increase. So relatively, Japanese yen value should decrease. Assume that the US experiences a significant decline in income, while Japan's income remains steady. This event should place what pressure on the value of Japanese yen? The right answer should be B, okay? When income level in US declines, there's less demand for Japanese goods, okay? Less demand for Japanese yen. So there is a downward pressure on the value of Japanese yen when the supply of Japanese yen doesn't change. The fourth factor is government control via imposing foreign exchange barriers, imposing foreign trade barriers, intervening in foreign exchange markets, affecting macro variables such as inflation, interest rates, and income levels. Okay, so government policies could affect exchange rates by setting barriers, or market rules, or changing the first three factors. For example, assume that the United States placed a strict quota on the goods imported from Chile and that Chile does not retaliate. Holding other factors constant, this event should immediately cause the US demand for Chilean pesos too, and the value of peso too. Which one should we choose? Right, we should choose C, okay, because this policy had placed a quota on imports from Chile. So the demand for Chilean pesos or the demand for Chilean goods will decline. Okay, so the demand for the currency will decline, the value of the currency will also decline. Assume that Canada places a strict quota on goods imported from the US and that the United States does not retaliate, holding other factors constant. This event should immediately cause the supply of Canadian dollars to be exchanged for US dollars too, and the value of the Canadian dollars to So here we see that the Canadian has a strict quota on goods imported from US. Okay, but US doesn't fight back. Um, so there will be less imports from US, right? So less people are exchanging Canadian dollars for US dollar. Okay, so there's a less or lower supply of Canadian dollars to be exchanged for US dollars. So we should uh, put decline in the first blank. And then when there is a lower supply and the demand doesn't change, the value of the foreign currency should, right, increase. Okay, supply decreases, value increases. Assume that Japan places a strict quota on goods imported from the United States. And as well, the United States places a strict quota on goods imported from Japan. Okay, so this is special because now we have two directions. This event should immediately cause the US demand for Japanese yen to, of course, decline, and the supply of Japanese yen to be exchanged for US to also decline. Okay, this is a special case. The two directions both have a lower demand for the currency or goods from the other country. Okay, so the supply to of the both currency also decline. The demand for both currency also decline. There's in general just less exchange between the two countries or two currencies. The last factor here is expectations. Okay, we have impacts of favorable expectations on future exchange rates. If investors expect the exchange rate in one country to rise, they may invest in that country, leading to a rise in the demand for foreign currency and an increase in the exchange rate for foreign currency. Okay, so this future expectations could be related to the first three factors as well. Here we're talking about the expectations on a rise of interest rates. So that's why we expect the foreign exchange rates to be rising. So the current exchange rate could be increasing because of our future expectations. Impact of unfavorable expectations. Speculators can place downward pressure on a currency when they expect it to depreciate. Impact of signals on currency speculation. Speculators may overact to signals, causing currency to be temporarily overvalued or undervalued. News of a potential surge in US inflation and zero Chilean inflation places what kind of pressure on the value of Chilean peso, and the pressure will occur immediately or only after the US inflation surges. Remember, when inflation increases, what happens to the demand for US dollars? Okay, so here we are combining the inflation factor with our expectation factor. Okay, when we expect US inflation to go up, remember the price in US will go up for the goods, so there will be a lower demand for US goods, lower demand for US dollars. Okay, but however, a higher demand for peso because more people are gonna buy foreign goods, right? So when the demand for peso is going up, the supply of peso is going down, right? The pressure on the value of peso should go up, right? There should be an upward pressure. And this will occur immediately, okay? Because we have this expectation, so this will occur immediately instead of wait until after inflation surges. Interaction of factors. Some factors place upward pressure while other factors place downward pressure. So far we've discussed about 5 factors, and we discussed each scenario when there's only one factor is playing a role, but when a few factors are influencing together, we see a combined effects from different factors. Okay, we have cases where one factor is making exchange rate up and another factor is making the exchange rate down. So the comprehensive effect would depending on the dynamics of the degree of each effect is. Influence of factors across multiple currency markets. Common for European currencies to move in the same direction against the dollar. Okay, so a lot of European currencies, they may move in the same direction because the economy or the policies of these countries could be similar in terms of moving direction. So this could happen. Influence of liquidity on exchange rate adjustment. If a currency spot market is liquid, then its exchange rate will not be highly sensitive to a single large purchase or sale. Okay, we've discussed about this before. If the market is liquid, is information efficient, is market has little frictions, then the price of the exchange of the currency or the exchange rate should be relatively stable, right? So there shouldn't be too much volatility, or it shouldn't be too sensitive to any single purchase. Summary of how factors can affect exchange rates. Okay, so we have trade-related factors, including inflation, income, and government control. We have financial factors, including interest rates and capital flow restrictions. Okay, so government controls, including government trade restrictions or capital flow restrictions. And for the trade-related factors, they could affect U.S. demand for foreign goods or foreign demand for U.S. goods, thus affecting U.S. demand for the foreign currency or supply of the foreign currency for sale, thus affecting exchange rates between the foreign currency and the dollar. On the financial side, the financial factors could affect U.S. demand for foreign securities or foreign demand for U.S. securities, and thus affecting U.S. demand for the foreign currency or supply of the foreign currency for sale, thus affecting exchange rates. Movements in cross exchange rates. Remember what a cross exchange rate is? It's not the exchange rate between the foreign currency and US dollar. It is between two foreign currencies. Okay, if currency A and B move in the same direction, there is no change in the cross exchange rates. Okay, remember, if currency A and currency B, they're both foreign currency, not US dollar, we say the exchange rate between them is cross exchange rate. And if they move in the same direction, then the cross exchange rate is still the same, right? When currency A appreciates against dollar by a greater or smaller degree than currency B, then currency A appreciates or depreciates against B. When currency A appreciates or depreciates against the dollar, while currency B is unchanged against the dollar, currency A appreciates or depreciates against currency B by the same degree as it appreciates or depreciates against the dollar. Okay, so we can use dollar as baseline. If B is the same whenever A appreciates or depreciates, the cross exchange rate also appreciates or depreciates. Example of how forces affect the cross exchange rates. So we can see here we have value of British pound, and also value of Swiss franc, and the cross exchange rate of pound in Swiss franc as the green line. Okay, so we can see as during the 5 years, the value of British pounds is going up first and then going down finally. The value of Swiss franc is going up most of the time. We can calculate their percentage change, and the cross rate of pound in Swiss franc is, we can just use their direct exchange rate with dollar, divide them. So we have the cross exchange rate, and we can see that it's relatively stable, but goes down a little bit. Anticipation of exchange rate movements, institutional speculation based on expected appreciation. When financial institutions believe that a currency is valued lower than it should be in a foreign exchange market, they may invest in that currency before it appreciates. So they think the currency is undervalued, they would invest in it because they think it's going to appreciate. When they think a currency is valued higher than it should be, they may borrow funds in that currency and convert it to their local currency now before the currency's value declines to its proper level. Okay, so when they think the currency is overvalued, they would short sell. Okay, they would borrow funds in that currency and convert it into the local currency now before the and when the value declines, they would exchange the local currency to the foreign currency and give it back at a lower price. Okay, so this is similar to short selling stocks, right? I'm sure you've heard about the GMC events and the short squeeze when they think, when a lot of institutions are thinks that the stock is overvalued, they borrow the securities at the high, borrow the securities and try to short sell them. Okay, speculation by individuals. Individuals can speculate in foreign currencies as well, just like institutions can speculate stocks or currencies. Individuals could speculate on stocks and currencies as well. For the US market, still, it's pretty much dominated by institutional traders. Most of the trading is conducted by institutional investors. Practice. In general, when speculating on exchange rate movements, the speculator will borrow the currency that is expected to appreciate and invest in a country whose currency is expected to depreciate. Is it true or false? Of course, it's false, right? It should be the opposite. Speculator will borrow the currency that's expected to depreciate, right? And invest in those ones they think is going to appreciate. Carry trade is where investors attempt to capitalize on the differential in interest rates between two countries. Impact of appreciation in the investment currency. Increased trade volume can have a large influence on exchange rate movements over a short period. Risk of the carry trade. Exchange rates may move opposite to what the investors believe. Carry trade example. When interest rates in England are 3%, while interest rates in the US are 1%, an American can take advantage of this situation by converting USD for GBP, British pound, and depositing the pound in a British bank, thus earning 3%. The deal seems even sweeter because during this time the GBP should appreciate. Why? How does this benefit the American investor? From the explanation above, this carry trade seems like a sweet deal. But what's the problem? First, timing. Second, many carry traders may reverse their positions at the same time, causing the British pound to depreciate rapidly. Practice. When investors engage in the carry trade, they attempt to capitalize on the difference in interest rates between two countries by borrowing a currency with a low interest rate and investing the funds in a currency with high interest rate. Is this true? Yes, this is true. If the Japanese yen is expected to appreciate against US dollar and interest rates in the US and Japan are similar, banks may try to speculating on this anticipated exchange rate movements by borrowing and investing. We always buy low and sell high, right? So if we think Japanese yen is at a low level now, it should appreciate, we should invest in yen, right? And the dollar is higher, overvalued now, we think it's going to go down, then we should borrow dollar, right? So it's C. When the Japanese yen appreciates against the US dollar, this means the US dollar is strengthening relative to yen. Is this true? No, it's not. Instead, Japanese yen here is strengthening relative to US dollar. Summary of our chapter 4 here. Exchange rate movements are commonly measured by the percentage change in their values over a specified period, such as a month or a year. MNCs, multinational corporations, closely monitor exchange rate movements over the period in which they have cash flows denominated in the foreign currencies of concern. Equilibrium exchange rate between two currencies at any point of time is based on the demand and supply conditions. Changes in the demand for a currency or the supply of a currency for sale will affect the equilibrium exchange rate. Okay, so we know that the exchange rate movements could be calculated as the percentage change, right? S minus ST minus 1 divided by ST minus 1. Also, the equilibrium exchange price is determined by the supply and demand curve, right? Remember the upward sloping supply curve and the downward sloping demand curve. They have a cross point. That's the equilibrium price. The key economic factors that can influence exchange rate movements through their effects on demand and supply conditions are the 5 factors here, right? Relative inflation rates, relative interest rates, income levels, government controls, and future and expectations on future exchange rates. When these factors lead to a change in international trade or financial flows, they affect the demand for a currency or the supply of a currency for sale, and thus the equilibrium exchange rate changes. If a foreign country experiences an increase in interest rates relative to US interest rates, then the inflow of US funds to purchase its securities should increase. US demand for its currency increases. Outflow of its funds to purchase US securities should decrease. Supply of its currency to be exchanged for US dollars decreases. And there should be upward pressure on its currency's equilibrium value, right? Because the demand increases and supply decreases. All relative factors must be considered simultaneously when attempting to predict the most likely movement in a currency's value. There are distinct international trade and financial flows between every pair of countries. These flows dictate the unique supply and demand conditions for the currencies, which affect equilibrium across exchange rates between their currencies. Movements in the exchange rate between two non-dollar currencies can be inferred from the movement in each currency against the dollar. Financial institutions may attempt to benefit from expected depreciation of a currency by purchasing that currency. Conversely, they can attempt to benefit from expected depreciation of a currency by borrowing that currency. exchanging it for their home currency and then buying that currency back just before they repay the loan. Okay, so that's all about the summary, and let me know if you have any questions on chapter 4.